Amazon, the $2 trillion e-commerce giant that accounts for nearly 40% of all online sales in America, is sounding the alarm about a major economic downturn. Their latest quarterly report reveals troubling signs that even the most resilient companies are starting to crack under economic pressure. With visibility into the purchasing behavior of over 200 million Prime members worldwide, Amazon possesses one of the most comprehensive views of consumer sentiment. During their Q4 earnings call, CFO Brian Ozlowski noted that customers remain cautious about their spending, with increased focus on value and essentials. Amazon's internal data reveals particularly concerning consumer spending patterns across product categories. Discretionary purchases are particularly affected, with electronics growth slowing significantly and home goods showing year-over-year declines when adjusted for inflation. Non-essential categories like clothing are also decreasing. Meanwhile, essential categories such as groceries and household supplies grew by just 2.1%, with consumers increasingly choosing lower-priced private label options. This spending shift clearly indicates financial strain among consumers, who drive nearly 70% of U.S. GDP. The company has strategically retreated from multiple business ventures. They've closed their Halo Health Devices division, terminated their Scout home delivery robot program, and closed numerous Amazon Fresh and Amazon Go store locations. Such abandonment of major investment initiatives suggests the company is not optimistic about consumer spending in the near future. Amazon's latest quarterly earnings report reveals concerning trends beneath the surface growth numbers. While they reported a 14% increase in net sales to $170 billion for Q4 2023, their AWS Cloud division, the company's profit engine, continues to show dramatically slowed growth at just 13% year over year, down from the consistent 30% plus growth rates of previous years. This AWS slowdown has sent shockwaves through the investment community as it signals widespread corporate belt-tightening. When businesses reduce cloud computing expenditures, it typically indicates preparation for economic turbulence ahead. Payment method changes across the retail sector are especially telling. According to industry data, buy now, pay later services like Affirm, which partners with Amazon, saw a 40% increase in transaction volume during the last few months. This surge in installment payments for everyday purchases signals financial strain among consumers. Amazon's trends aren't happening in isolation. Target reported a 3.8% decline in comparable store sales last quarter. Walmart, despite its reputation for value, only saw a 0.8% increase, well below their historical average. These retail giants collectively serve as early warning indicators for the broader economy. Consumers are trading down to lower-priced alternatives and prioritizing necessities over discretionary purchases across all major retailers, confirming a broad-based shift in consumer spending patterns that suggests deeper economic concerns ahead. Amazon's warning signs align with troubling economic data across multiple sectors. Consumer confidence has dropped significantly, with the University of Michigan's Consumer Sentiment Index plummeting to 57.9 in March, a two-year low, down from 64.7 in February, and the Conference Board's Consumer Confidence Index dropping 7 points to 98.3 in February. According to Federal Reserve data, revolving consumer credit, primarily credit cards, increased in December 2024, pushing total credit card debt above $1.21 trillion for the first time in history. Americans are increasingly relying on credit cards to maintain their standard of living as inflation continues to erode purchasing power. U.S. retail sales provided another red flag, decreasing 1.2% in January 2025, far exceeding the 0.1% decline economists had forecast. Even online retail sales specifically decreased by 1.9%, indicating that the pullback in consumer spending is affecting e-commerce broadly. What makes these indicators particularly troubling is their convergence. When consumer confidence falls, credit card debt rises, and retail sales decline simultaneously. It creates a perfect storm for economic contraction. According to data from the Federal Reserve, consumer debt has now reached a staggering $18.04 trillion, with credit card debt alone exceeding $1.21 trillion for the first time in history. The average American household now carries $9,700 in credit card debt, with interest rates averaging 22.8%. The housing market is showing clear signs of stress as well. Mortgage applications have fallen for 6 consecutive months, down 6.9% from last year, according to the Mortgage Bankers Association. The median home price has started to drop in 37 of the 50 largest metro areas across the country. Just last week, the Commerce Department reported that new home sales plunged 10.5% from the previous month to a seasonally adjusted annual rate of 657,000 units, and were down 1.1% year over year, the lowest level since November 2022. This is particularly concerning for those of you who have investment properties or are considering downsizing in the near future. The economic contraction isn't limited to the private sector. Similar to what we're seeing with the Pentagon layoffs, various government agencies have announced workforce reductions. The Department of Commerce recently announced plans to cut 4,800 positions, approximately 6% of its workforce, while the Department of Transportation is looking at eliminating 3,200 roles. These government job cuts have a multiplicative effect throughout the economy, as each government position typically supports 1.5 additional private sector jobs through direct and indirect spending. What makes this particularly concerning is the timing. Government employment has historically been a stabilizing force during economic downturns. The fact that we're seeing significant government contraction before the broader recession has even been officially declared suggests that the coming downturn could be more severe than many anticipate. Amazon isn't taking this economic warning lightly. They've already begun implementing cost-cutting measures across their organization. They've frozen hiring for all non-essential positions, closed 43 underperforming warehouses, and delayed the opening of 12 new fulfillment centers that were previously scheduled for 2025. In January 2024, Amazon laid off 18,000 employees. They've also scaled back their ambitious expansion plans in several key areas. Amazon has indefinitely postponed their healthcare initiative that was meant to revolutionize the industry. They've scaled back their brick-and-mortar retail plans, closing numerous Amazon Fresh grocery stores and Amazon Go convenience locations. But perhaps most telling was Jazzy's comment that Amazon is repositioning for a prolonged period of economic uncertainty. This isn't the language of a company expecting a minor slowdown. This is a company battening down the hatches for a serious economic storm. In February 2025, the Conference Board's Consumer Confidence Index fell by 7 points, the largest monthly drop since August 2021 to 98.3. Marking the third consecutive month of decline. Even more concerning, the Expectations Index, which measures consumers' short-term outlook for income, business, and labor market conditions, dropped to 72.9. Any reading below 80 typically signals a recession within the next year. A recent survey from Morgan Stanley found that 68% of Americans believe we're already in a recession, regardless of what the official economic indicators say. This perception becomes its own reality as consumers pull back on spending in anticipation of harder times ahead. The University of Michigan's Consumer Sentiment Index showed that expected business conditions for the next 5 years plummeted to 57.9, a 10.5% decline from February, and the lowest level since November 2022. This is a dramatic shift in outlook that typically precedes major economic contractions. For those of you who are homeowners or real estate investors, the warning signs from Amazon and other retailers should be setting off alarm bells. The housing market has historically lagged behind consumer spending trends by about 6 to 9 months. The National Association of Realtors reported that existing home sales fell 4.9% in January, marking the 7th consecutive month of decline. The inventory of unsold homes has increased to a 4.2-month supply, up from 2.9 months a year ago. Housing starts have fallen 13.5% year over year, according to the Census Bureau, with single-family construction down 18.6%. Builder confidence, as measured by the NAHB Wells Fargo Housing Market Index, has dropped to 37, well below the neutral 50 threshold. Morgan Stanley's housing analysts recently revised their 2025 home price forecast from a 2% increase to a 4.5% decline. Goldman Sachs has similarly adjusted their outlook, now predicting a 6.2% decline in home prices over the next 12 months in major metro areas. Please take 2 seconds to help me out and hit the like and subscribe if you find this video interesting so far. Each like and subscribe helps support this channel and keeps us motivated to keep making you great content. Thank you. Now, let's continue. If you're an investor, particularly one nearing or in retirement, these economic warning signs require immediate attention. The traditional 60-40 portfolio, 60% stocks, 40% bonds, that has served investors well for decades is showing signs of strain in this economic environment. With both stocks and bonds under pressure, diversification strategies need to be reconsidered. Gold has seen a remarkable rally, up 23% over the past 12 months, and recently crossing the $2,700 per ounce threshold. Silver has performed even better, up 29% in the same period. Tips: Treasury inflation protected securities are seeing unprecedented inflows as investors seek shelter from inflation while still generating income. The iShares TIPS Bond ETF has seen $7.2 billion in new assets over the past quarter. Value stocks with strong cash flows, low debt, and essential products are outperforming growth stocks for the first time in over a decade. The Vanguard Value ETF has outperformed the Vanguard Growth ETF by 7.3% year to date. So, what should you be doing right now to prepare for the economic contraction that Amazon and other major corporations are clearly signaling? First, reduce your debt exposure immediately. With interest rates likely to remain elevated despite economic weakness, a phenomenon known as stagflation, carrying high-interest debt will become increasingly burdensome. Second, increase your emergency fund. The standard recommendation of 3 to 6 months of expenses should be extended to 9 to 12 months given the potential severity of the coming downturn. Third, reassess your real estate holdings. If you're over-leveraged or holding properties in markets with declining population or job growth, now may be the time to consolidate your positions before prices fall further. Fourth, consider defensive investment reallocations. Utilities, consumer staples, healthcare, and select energy companies historically perform better during economic contractions. Companies with strong balance sheets and consistent dividends provide both income and relative stability. Fifth, look at alternative investments that have low correlation to traditional markets. Besides precious metals, consider farmland REITs, infrastructure funds, and select commodities that benefit from ongoing supply chain restructuring. What we're seeing with Amazon and the broader economy should be especially concerning for those of you with retirement accounts and pension funds. The traditional retirement planning models that financial advisors have used for decades were built on assumptions that simply don't hold in our current economic environment. The average 401k balance for Americans aged 55 to 64 is about $232,000 according to Fidelity's latest retirement analysis. That may sound substantial, but with inflation eroding purchasing power at an accelerated rate, most financial planners now estimate you'll need $1.8 million to maintain a middle-class lifestyle through retirement. The math simply doesn't add up for most Americans. Pension funds are facing similar challenges. The funded ratio of the 100 largest corporate pension plans dropped to 92.7% in the last quarter, according to Milliman's Pension Funding Index, down from 96.3% a year ago. Public pension systems are in even worse shape, with the average state pension fund only 75.6% funded according to data from the Pew Charitable Trusts. What makes this particularly troubling is that these pension funds are still projecting annual returns of 7 to 7.5%, yet have only achieved average returns of 5.5% over the past decade. With Amazon and other market leaders signaling economic contraction, even these diminished returns may prove optimistic. The traditional retirement safety nets are showing significant strain. Social Security's trust fund is projected to be depleted by 2033, according to the latest trustees report, at which point benefits would be cut by approximately 23% unless Congress takes action. Medicare's hospital insurance fund faces insolvency even sooner, by 2028. For those within 10 years of retirement, this economic warning from Amazon and other indicators means you may need to dramatically reassess your timeline and expectations. Many Americans are already adjusting. A recent survey from the Employee Benefits Research Institute found that 42% of workers now expect to retire after age 65, up from 16% in 1991. Despite these concerning signals, there are opportunities for prepared investors. Economic contractions create favorable conditions for those with liquidity and patience. Real estate investors who maintain strong cash positions will find exceptional buying opportunities as distressed properties come to market. The coming months could present the best real estate investment environment since the aftermath of the 2008 financial crisis. For stock investors, market downturns have historically been the best times to acquire quality companies at discounted prices. Investment legend Warren Buffett increased his cash position to a record $189 billion in anticipation of such opportunities. Small business owners with solid fundamentals will face less competition as weaker competitors exit the market. The post-contraction period typically features reduced competition and lower operating costs. Amazon's warning signals about the economy aren't just corporate news, they're a clear indicator that we're entering a significant economic contraction that will affect your investments, your real estate holdings, and your retirement plans. The combination of declining consumer confidence, government layoffs, housing market weakness, and retail struggles points to a perfect storm that could make the coming recession particularly challenging. But remember, economic cycles are inevitable, and those who prepare diligently not only survive downturns, but emerge stronger on the other side. The actions you take in the next 3 to 6 months will determine whether this contraction becomes a crisis for your financial future or an opportunity to strengthen your position. If you found this analysis valuable, make sure to subscribe to the channel for continued insights on protecting and growing your wealth during these turbulent economic times. Thank you for watching this analysis, and please make sure you subscribe for more market insights if you found this information valuable. Share this with a friend and watch this one as well.